class, there was 2 lessons from Chapter 7 that we didn't get to go over, and I want to go over them with you so you can have this information for when you take the exam. The first lesson, or I should say, before I start and move forward, both lessons deal with the effects of inflation, the effects that inflation have. First, on your wages, and second, on interest. Now, I want to start with the second point first. We all know that interest is equal to the price that's charged for a loan. And we know that interest is part of income. And interest really is what the borrower pays to the lender because the lender foregoes use of that money for a period of time. So in order to forego or to give up use of that money, they need to be compensated, and they're compensated with what is known as interest charged to the loan. Now, most of you have interest or have savings accounts that generate an interest rate. Some of you may have interest-bearing checking accounts. Some of you may have certificate of deposits or CDs. Almost everyone has a credit card with a rate associated with it. The rates that are stated to us are known as the APY, or the annual percentage yield, or the APR, which stands for the annual percentage rate. Banks have to, or lenders have to, declare the rate in these terms because of the Truth in Lending Act of 1968 and the Truth in Savings Act in 1991. Now, when you see this APR or this APY rate listed on your accounts, you may see it as 1%, 0.1%, which is really equal to 1/10 of 1%. You could see it for your credit card loans. Sometimes it's at 12%, so on and so forth. This APY is also called the stated rate. In economics terms, this stated rate, or API, is referred to as the nominal rate of interest. The nominal rate of interest, or N, is equal to the real rate of interest, or R, plus the inflation rate. If we know any two of these variables, we could solve for the third. Now, the nominal rate is what is charged and what you receive in any given year. Just like nominal GDP is GDP in that year's dollars, the nominal rate of interest is stated, let's use 11%, in the year the loan is originated. That rate, in most cases, is going to be fixed, which means it doesn't move over the whole term of the loan. We all know that prices rise year over year. So when that person or that lender foregoes the use of their money for a period of time to lend it to someone else, and they charge an interest rate, and that interest rate is made in the year of origination, what happens in the following years if the rate of inflation goes up? If inflation increases, the value of the loan decreases. So in an environment of increasing inflation, borrowers are helped because they're paying the money back with future dollars, and future dollars tend to be greater than today's dollars because of inflation. Now, lenders realize this, but no one with 100% accuracy can predict what's going to happen into the future. So what lenders do when they're pricing, or the financial intermediaries, as we learned in Chapter 6, are pricing the loan on behalf of lenders to borrowers, what they do is they take an average inflation rate, or what they think inflation is going to run over the longer period, or the period of the loan, and they add it in. However, in year 5, if the nominal rate is 11% and inflation is 4% in year 5, that means the real return to the investor or to the lender is 7%. That means that the income they receive from interest will only earn them 7%, or only be able for them to purchase 7% in current year's dollars. Let's look at another example. If a current 30-year home loan is quoted at 5%, and the 30-year running average for inflation is projected to be 3%, what is the real interest rate on this loan? And the answer is simply your nominal rate of interest, or 5%, is equal to your real rate of interest, which we don't know, so we'll say it's X, plus our inflation rate, which we know is 3%. Using our algebraic rules, when we bring over that 3%, we know then that 5 minus 3 is equal to X, and that means that X, or real interest, is equal to 2%. I now want to focus on inflation's impact on wages. Wages are what households receive in return for providing labor to organizations. It is by far, as we've learned in Chapter 5, by far the greatest percentage of income in the United States. Now, when we make, say, $100,000 a year, if we're lucky, we know that we have to subtract out our tax burden from that. And that 100,000 or taxes is referred to as our disposable income. That disposable income is what we use to buy the goods and services in the product market that makes the circular flow model go around. In case you don't remember, we have households, we have the factors markets, we have firms, we have the product market. Households sell their labor in the factors markets to firms in return for wages. They then use those wages to purchase the goods and services that they need in the product market. That means that firms will then have to produce more products, purchase more factors of production, so on and so forth, for this model to spin and keep spinning in a healthy fashion. However, when there's inflation, disposable income can be affected, and we're going to take a look at how it's affected. If your disposable income stays the same, say in 2013 from 2012, and we know that the price level increased from, say, 110 in 2012 to 115 in 2013, we know that we have about a 4% inflation rate. Because of inflation, we know that if we bought $90 worth of goods and services in 2012, that they're now worth somewhere around $94 in 2013. If our disposable income is only $100 and it stays flat from 2012 to 2013, that means once we buy all the goods and services we desire in 2012, we have savings of $10. That $10 savings, as we learned in Chapter 6, can be lent out. However, our disposable income stayed the same in 2013, but the price of goods and services went up, so that means we only have $6 left that could be lent out. That $4 difference is a decrease in savings, which would lead to a decrease in investment, because in Chapter 6 we learned that savings equals investment. Additionally, people's gross pay can be affected by inflation. And an easy way of looking at that is to calculate someone's purchasing power, or what's known as purchasing power parity. And the way I like to calculate this is taking a look at last year or year one salary, say $50,000, and year two salary, say it's again $50,000 because there was no raises, and an environment of 2% inflation. Just as in calculating the price level, the base year, in this instance year one, the price level is always going to be 1. So our real wage, i.e. gross wages or gross pay adjusted for inflation in year one, is $50,000. Just like nominal and real GDP are the same in the base year, in the base year of any calculation, nominal wages, or what your gross pay is, and real wages adjusted for inflation are equal in the base year. However, in the second year, your real wage will either decrease or increase depending on what your nominal wage is versus the inflation rate. In our example, the nominal wage stayed the same. So nominal wage is equal in 2012 and in 2013. However, we know that inflation ran at 2%. Still mild, but it means that there was a price increase. How much can our $50,000 in 2013 purchase in that year? And the calculation that I use is just take the nominal wages in year two, so in this instance, $50,000, and I multiply it by 1 minus the inflation rate. So in this case, 50,000 times 0.98, or 1 minus 0.02, would give us a real wage of $49,000, which means that if your boss comes to you and gives you a choice of whether you're going to lose your job or not get a raise, of course everyone is going to choose the option in which they continue on with their employment. However, because of inflation, we can buy less in that next year with that same wage than we could in the current year, because inflation raises the prices of the goods and services that we desire. So even though our incomes are flat from one year to the next, our purchasing power has decreased because the goods and services that we buy are more expensive, which means in year two we can only purchase $49,000 worth of goods and services. This just about wraps up the lessons or the learning objectives for Chapter 7. Make sure you review this lecture or keep it handy as a reference for when you take your exams over the weekend. Good luck, and I'll see you on Tuesday.